Hi, this is Karthik and welcome to another Varsity video. Today, I'll talk to you about a market experience that still haunts me. I vividly remember the sentiment in the market was very weak around mid-2013, primarily driven by the fear that the US government would shut down, scary Chinese number, and political instability in Europe. In September 2013, Nifty was trading around 5,285 after correcting from July high of 6,065. Roughly a 770-point correction or about 14.5% decline in just a matter of 1.5 months. Every quality stock was trading at a dirt cheap valuation, but nobody literally was interested in buying stocks, a very typical bear market behavior. I had a bunch of stocks in my watch list, and one particular stock was very close to the price at which I wanted to buy. The stock was selected based on fundamentals. Let me give you some hints, maybe you can guess the stock that I'm referring to. The company had a great business. The company was into aluminum die cast for auto components. The group company had a multi-decade reputation for business ethics and transparency, which in my opinion is a key driver for investment decisions. The business of the company was solid. The top line of the company was in double digit. The company was profitable. The company had both secured and unsecured debt, but the company had indicated that they were on track to reduce the debt. Besides, the debt coverage ratio was not bad at all. The company was generating free cash flow. The company fared well across all key financial ratios. Technically, the stock stuck between a range of 275 to 300 for a very long time. Despite the overall weakness in the market, the stock didn't crack below 275, which gave me the additional conviction to go ahead and buy the stock. Combining both FA and TA, I was convinced that this was a good long-term bet. Fundamental analysis gives you the conviction to hold the stock for long term, whereas TA gives you the conviction to go ahead and press that buy button. Hence, it's always a good idea to combine both. By the way, when I say long term, my intent was to hold the stock for at least 5 years. When you invest in a stock for long term, you stay invested in it as long as the original investment thesis remains intact. You sell it only if the business goes off track. Anyway, so it was September 2013, and with all my research, I decided to buy the stock at 275, the lower end of its trading range. Lower end because I knew the overall market was weak and I was convinced that I would get the stock at 275. So I placed an order to buy the stock at 275.1 and I logged off the system. I logged back in just before the market could close to see if my order was executed. The stock made an intraday low of 275.15, just 5 paisa above my limit order price, and it bounced from that particular level. The stock made an intraday high of 277 and closed somewhere around that price. I was okay with it and I was not really concerned that my order was not executed. The overall market was weak and you don't really chase prices in a weak market. I decided to place the order again at 275.1 the next day, and I did. The stock opened at around the previous day's high point, that is about 277, and continued to trade in the same price range. My order was pending at 275.1. The broader markets were flat. Select stocks started to bounce, but the stock that I was interested to buy continued to trade around 277. Sometime around noon, activity started to pick up and the stock price moved to 280 from 277, while my order was pending. I could have easily modified my limit order and bought the stock anywhere between 275 and 280. It would make no difference given the fact that I wanted to hold the stock for the next 5 years. But no, I was determined to buy at 275.1. And the market closed that day, and for second consecutive day, my order was not executed. On the third day, I was adamant and I placed the order again at 275.1, hoping to buy the stock. But the stock started to trend higher. The stock price went from 280 to 282, 282 to 284. And after a while, I started to feel that the stock price has gotten expensive. And I justified to myself why I didn't want to buy the stock at higher prices. I was still stubborn to buy the stock at 275 only. In the trading world, this is called the anchor bias. Anchor bias gets you fixated on a reference price and makes you act only around that one particular price. and you kind of lose your sense of rationality. What happened to me in September 2013 was anchor bias, and thanks to that, I let the opportunity slip by. And that taught me a very expensive lesson. The stock that I'm talking about is Sundaram Clayton, and here is what happened to the stock price since September 2013. Markets has a way of teaching you a lesson, and these lessons remain etched in your memory. Some of these lessons can be very expensive. I would love to hear lessons that market has taught you. Please do comment below and share your experience. I hope you found this video useful. I'll see you guys in the next one.